Right, good evening, everyone. It is 7:20 Eastern Time, Sunday, the 3rd of May. Welcome to another Unmissable Sunday show. We are going to go through a bunch of stuff this evening, but really the focus of the day is a check-in on positioning. Hey, Ben, how are you? Sorry about the slow start. I had broadband issues this morning. Monday morning
Glad to see
wake
you,
up.
not me. I feel like
I know,
LA is getting a bad rap from you lately. Good to know Australia's got their own issues.
Listen, I thought we'd start here with wow, I can't believe it was 6 weeks ago that we had our Ags week. With Nico Hoyt, who both of us been in touch with a lot recently, and that was the red circle on that chart there was Ags week, and this is the corn, wheat, and cotton charts in the background ever since. So this Ags trade has been really the driver of my returns while I've been so degrossed during these last few weeks of the war. The other thing that seems to be driving returns for me recently is the Canadians. The M&A bankers of Bay Street in Toronto keep on bidding for all of my energy stocks and my gold miners. My namesake Rupert Resources was the week before last, and then last week we saw Shell come in and spend $16.4 billion on ARC Resources, the Canadian gas play. So thank you to the M&A bankers of Toronto.
Well, thank you, but not thank you, because as we talked about with Adam on Thursday's show, you guys should go check that. Is small cap. We focus on small caps. He's a small cap manager. I talked about special situations. My biggest gripe of why I kind of moved from doing that a lot was now you got to find a new trade. Now that these guys are out of your portfolio, you got to find something to do with the cash.
Absolutely, and you got to revisit, go back to the original shortlists and dig again. And it's always hard to find a like for like situation. But listen, I'm not gonna turn my nose up at these at a 30% bid premium when I'm underexposed to equities right now at the moment, which sort of brought me on. I wanted to do an exercise of looking at I benchmark my beta portfolio against a target date fund from Vanguard, a 2035 target date retirement fund. And that's a kind of classic 60-40, 70-30 bond stock, global bond stock mix. But I also follow 5 ETFs that do roughly the same job, which is you've got Meb Faber from Cambria's Trinity, you've got the Bridgewater All Weather, you've got Warren Pies from 314's his real asset allocation portfolio, Bobby Elliott's unlimited HFND, which is a sort of hedge fund replication product, and then RPAR, which is the Evoke risk parity product. And this is Bushy's in brown versus those, the S&P and the VTTHX, which is the Vanguard mutual fund that I talked about. I really wanted to check in on and by the way, this is how Bushy is currently positioned. I'm 35% in cash and hedges, just over 6% in gold. Then there's that sleeve, which has really been driving performance, the purple ag commodities sleeve, just under 15% in trend followers. Then we've got the emerging market local currency bonds, and the balance just over 22% is equities. And I wanted to check in and see where the rest of these guys were in terms of their sort of globally diversified multi-asset portfolios. And I just sort of pulled down the holdings at the tail end of last week to take a quick look at it. I mean, funny, you look at the Bridgewater fund, and Bob obviously was a co-CIO at Bridgewater before with his unlimited fund. These guys are pretty defensive. If you look at where the all-weather is in terms of bonds, tips, bond futures, and cash. And then Bob over there with 47% in cash right now. These guys are prepping for World War III, which I thought was an interesting takeaway. And then in terms of diversification, I think Meb over at Cambria is a bit of my spirit animal when it comes to asset allocation. He's very much a global diversifier. Then the other end of the extreme, you've got Warren over there that is all US stocks. He basically owns negligible amounts of equity exposure outside. And, I still, for my mind, quite a lot of bonds, right? Anyway, I thought that was interesting to take a look at. I mean, what you've been looking at positioning on the rest of the market. Do you want to talk about that a little bit?
Sure. I mean, again, kind of go back to what we like to talk about, that most of what matters in the short term, and in a world that seems to care the most about the short term, is leverage and positioning. We've talked on the show numerous times how at the end of March, positioning was really, very hedged, very bearish, or not maybe bearish in the sense they sold assets, just, the CTAs and the guys who were the discretionary movers were one way. What I kind of thought was interesting here is that we've had a pretty big deleveraging. The Goldman Prime book, I found, I have like widgets on their Market View app, and the slide on the right, it combines the two of them. I got that one from the Marketeer, but they got it from Goldman, so it's Goldman's chart from their Prime book. It's a good deleveraging, and one of the stories up until recently had been, the net's not really, it went down in Liberation Day, obviously. Then it rebuilt, but kind of was in that range of 50 to 58, kind of with the exception of the Liberation Day. But the gross, basically from the 22 low until about the time silver peaked, was pretty much rising. And we've seen a deleveraging since then. So what lens you come at with it is kind of probably a function of your bias towards the market. If I'm a bull, I say, oh, well, they got more room to run, they can add more back. Or you could take the other side of, hey, positioning is such that maybe these guys are concerned, right? If you're a big fund, you don't necessarily trade for a week or 2 weeks. You're trying to trade for what's going to happen in the next 6 months to 18 months. And so it's just something that I thought was interesting. And then you think about the top left is, there's been a pretty big degrossing in tech, which is, they don't break out in that Goldman chart, whether that's software or hardware. And as you can see in the bottom, that's a big difference, right? Because as you know, and we'll talk about it a little later of how it came. Everyone's basically all in on the whole semis, memory, capex, boom, beneficiaries. And then pretty much everyone's negative on software right now. Everyone's going to vibe code their way to, Valhalla. But in general, it's a weird situation because positioning is such that markets keep going up. So you would think, well, this means we can go to another leg. But I sometimes think about it differently, where it wouldn't maybe take that much for us to get just a correction, even hey, let's go retest 6,700, 6,800 and see what people are made of. Do we get bought there or something? Because I'll tell you what, we've talked about it, Rupert, but that was an unbridled orgy of risk on for a month straight, right? April was one of the most ubiquitous one-way bull months you'll ever see, basically. And it was Mythos from Claude that got a lot of people excited. It was the scaling back
the memory trade out of Korea.
Well, yeah, I think the Mythos was what really got people excited about that and really took it to another leg. But it was initially the positioning, and then I think Mythos is what took us from just going from 63, 6,400 back to 6,800 to then now 72, 7,300, right? Just to use S&P terms, just because it's an easy proxy. But yeah, let's go to the next slide.
Let's talk about Asia, because
this was
interesting.
Yeah, because Rupert wrote about China over the weekend, his weekend notes. So I decided I hadn't looked at China in a while, so I went through about, I don't know, 100 charts of China on Goldman's little nice app and all the different widgets they have, and then I went through maybe one or two other investment banks and just kind of went around. And in the light of the positioning, they are at the peak gross leverage for the post-COVID period, I guess you could say, which is interesting because the property market has not recovered at all. It is not good.
There's a different bull market structure in place here. I mean,
Totally.
they have done a deliberate deflation, if you like, a controlled explosion of the real estate market. They don't want that to be the primary savings vehicle. And actually, this is a good segue into my piece, because I've been a China bull, right, since Halloween 22, right, and I was overweight by the summer of 24 in my book, and then we had the Tepper spike in September that year. But really what I realized over the course of the last sort of year to date, and really having this sort of Hormuz related sort of buyer's strike, has given me time to really think about how I'm positioned around all of my themes, and particularly around how I'm positioned on Chinese equities. And I realized that I wasn't listening to the game master, right? This is Jim Leitner's concept around, there's always, whether it's a very powerful Treasury Secretary in the US, or in the case of China, it's very clear what the authorities want to see as a priority. They're engineers. They plan stuff. They lay out 5-year plans. And it's very clear that my positioning, which was trying to anchor off, the potential for recovery and consumption in China, was leading to overweights in my book. And that's a mistake, because, they come out with 5-year plans, and, developing consumption barely makes it to the top 5 priorities. The priorities there are AI, tech sovereignty, sovereign resilience, and that's where you need to be overweight. So I put together republished my sort of concentrated China portfolio overnight, which is waiting for execution once we've got these bloody straits back open.
Yeah, and there was a headline. Let's see, I'm looking at my Bloomberg Launchpad right now. Something about some boats guide ships through. Yeah, so Brent's down on plans to guide ships through. I don't know. I mean, I sent you that website that just kind of aggregates it all. Somebody built from I don't know, Claude or Gemini, or no, maybe it was from Manus. But so we're still not there, but there's expectations and hope and headlines that it's coming. So, but again, this is not like sending a swap line, where you can do it instantly. Like, these are sending boats and getting other boats, and
listen, it would take a lot more than a rumor of some escorted tankers and container ships for me to get excited about adding back risk here, right?
Or maybe it's just more of the oil trade, the energy trade, some of the stuff that's gotten bid because of it being closed. That's more the immediate impact than just general risk. You know what I'm saying? I think general risk has already front ran this.
Okay, let's just quickly finish up on China here. I mean, one of the things that I sort of called for at the beginning of the year is this outperformance of Chinese A shares versus offshore H shares that started in the middle of last year and now has really sort of pressed on. And I think when I add back my beta exposure to China within Bushy, it's going to definitely prioritize the A share exposure, and I'm just going to stick to stock picking when it comes to the offshore element. If you look at earnings estimates on the CSI 300, everyone's talking about the rip in earnings expectations that we're seeing in the S&P, driven largely by energy and memory stocks. I lifted this slide here. If you look at Micron Micron is almost, well, it's over a quarter of contribution to S&P EPS revisions so far this year, which is pretty staggering. And then some big delivery numbers from the energies.
Yeah, look at that. Yep. Yeah, I saw this when I was going through some of the bank charts. I mean, the concentration.
And everyone will have seen it. It was in the daily. It was in the daily short. Well, listen. Why don't we kick off with that thing on that thought on concentration?
Yeah, I mean, there's just as a start, there was the McGillicuddy note that I read last week. And he's always pretty sharp. I'm not a Nomura customer, so I get it secondhand. But if he would actually be the only reason that I would try to be a Nomura customer. He's pretty solid. He has a good grip on market mechanics. But there was, the bottom chart is kind of what Rupert was talking about in the last one, where, there's just a small amount of stocks that contributed most of the rally. So we're kind of back to the old market. We had like 1 to 2 quarters of a little bit of dispersion and broadening out. And now we're just kind of back to, small amount of stocks contributing most of the market, the Mike Green market, let's call it. Basically, but the one thing here,
I tell you what, it's the market that's an absolute nightmare for people that try and write something interesting about the market every week. It's a disaster for the newsletter writers. If we go back to Mag 7 dominance, I tell you,
that's true. But this was also from a mutual fund and long short angle of, hey. And I know this because I know a bunch of guys who are portfolio managers, having grown up in this game. It's hard for people to just be long the big top stocks because the general thing is, hey, I'm a smart analyst. I can find what the market's not seeing. And so there's some level in what McGillicuddy called it was a alpha bucket. So, hey, I need to have some capital sitting around so that I can go find it or use funding if you're long short to fund that stuff. And I think what he's saying is that what the up and to the right in a vertical manner that we just saw was a lot of guys repositioning, having to get their funding things under control, and basically getting left behind. So there was the initial positioning, then there was some of the mythos excitement, and then there was a bit of a chase. And it's made for a great month. And then basically. Here we go is let's talk about capex. Let's talk about last week was the biggest earnings week of the year or the quarter or whatever. We had a Wednesday that $12 trillion of cap reported, I think making it the greatest single day amount of cap ever. And I created a website via Claude that kind of just has the data for their capex, normalizes the percent of GDP, and then uses whatever the Wall Street current estimates are. And it's pretty incredible if you think about it. Like we went from the big 5 hyperscalers, which includes Oracle, as maybe 60 bips of GDP. And based on this year's estimates for GDP and capex, it's going to be 2.4. So almost 180 bips of incremental gain. And, I have a couple charts here, and you can see the estimates pre and post for their capex numbers on the left. Pretty big boosts, started Q1 earnings season versus now, right?
When do you think the plunging free cash flow starts to impact how these stocks are valued, though?
Well, let's talk about that. Let's talk about that in a second because I want to get there. So this is just, and you can see in our slide deck, our paid subscribers we put this out. There's a lot to go through, but this just puts in perspective the quarterly actual numbers, percentage of GDP. You can see the percentage of EBITDA. Oracle's the only one that's completely offsides, but now Amazon's spending more than their EBITDA and capex, and the other guys are all in the 70s. And then there's little Apple or Big Apple down there at 5. Just waiting for some people to fall apart so they can buy them on the cheap. But these numbers are incredible, right? Any way you slice it as a percentage of total investment in the country, it's $1 out of $8, percentage of EBITDA, just the numbers are up and to the right. And anybody in that, fire hose, as we've chronicled many times, is also up and to the right. So I wanted to just kind of talk about, because there's over the last month we've had this consistent thing of a lot of market participants that I talked to, newsletter writers. There's a general level of confusion, right? And humans love to put narrative behind price action. So I wanted to talk about the capex now that we have the results and the updated guidance within the collective profit equation, because this is something I learned about a long time ago, and it rejiggers, and I'll send the paper out for people, but like it rejiggers the GDP equation, because basically investment equals savings. Like that's kind of one of the core tenets of economics, to divide, showing the sources of profits. And I think when we think about most people, they care about profits because that's what stocks are built off of, and that's what pays for credit, more or less, right? And this is a busy slide, but I'll come and show you the general idea is up on the left, or net investment minus non-business savings plus dividends plus taxes, is where profits come from. Now let's unpack that just a little bit on the next one, because this is busy. Or maybe I didn't put the right one up, damn it. Okay, well, the general idea is that the number one sources of profit growth is investment, capex. And then the other one that's really big is savings. So when the households desave, like personal savings going down, like think about the run up to 08, that helps profits. And when the government saves or dissaves is, even bigger. And so, the government has a $1.9 trillion deficit in the US, and you have now this gigantic capex boom. Well, there you go. Like there is where your source is. And since, this is an accounting identity, the reason why it jams profits is because the revenues all recognized this year, but the costs aren't all recognized this year. And remember, my revenue is someone else's costs, but from an accounting perspective, we're not recognizing it. We're recognizing it over the future. So it comes to the bottom line. And so then what you see, and this is just a way of seeing it within the hyperscaler, where you see, okay, net income's ripping, everybody's earnings, EPS are just up and to the right, revisions are up and to the right. The processing unit is that there's this gap between capex and depreciation, right? And so then that's where you're getting this huge difference between free cash flow and net income. To come back to what you're saying, I'll show you a few charts in a minute. And so free cash flow is just pathetic. You see this, but I have another chart in the future, whereas earnings are insane, because really you're just trading cash for earnings in some sense, like at a first principles level. And here, look at the Q1 earnings, like where that went. Like, if you're an old school believer that stocks follow earnings expectations, well, here you go. It looks like the S&P straight up and to the right, right? And look at this from Goldman on the right. They're going to talk about 25% earnings growth in the Q1. I mean, that's pretty incredible, honestly. And looking at like 20% of the year
doesn't sound late cycle, does it?
No, it doesn't. No. Well, I guess that's what I'm trying to take a little first principles tour here on the Unmissable Sunday show of saying, okay, here's the math and here's the identities of how this can happen. So here I got this chart from Twitter, some guy named Kevin Smith, but I mean, I could have recreated it, but I was lazy. But, stocks follow free cash flow until now, right? Like you're seeing that red line is the S&P, and then this is the aggregate of these guys, capex, and then now, or free cash flow, now it's just plunging and stock market's ripping. And, this is the chart was on the 4 where earnings 177 of the big 5 hyperscalers, and there's their free cash flow. That's a big gap. Is that $135 billion gap annualized to $500 billion? Corporate profits are 3 or 4 trillion, maybe. So you're talking about.
You and I are both big free cash flow yield guys, right? And for us, this is a very, very problematic chart in terms of, core tenets about how we think about stocks, right? But it doesn't seem to be bothering the broader market in any way, shape, or form. What would cause that to, change perception or change, risk tolerance for the broader equity investor?
Well, I think for me, what would happen is that people expectations for future free cash flow would have to come down. Right now, you're like, hey, they're investing, So if you're a bull, and I've had this conversation with people, like don't doubt Zuck. Don't doubt these guys, like these godlike figures. They know what they're doing. It's like, maybe. Well, Larry Page was quoted saying, I'd rather go bankrupt than lose the spending race. Okay, that doesn't sound like a super objective. That's a guy who's already rich, probably has money put away in different things, and he's like, I'm going for it. And then the other guy's like, I'm going for it. And then all under the guise of, well, we got to beat China. So you have like a prisoner's dilemma, from a game theory standpoint, where everybody feels like they need to spend in order to be the winner. And then, there's not a rational strategy necessarily for a long-term equilibrium, but in the short term, at the agent level, it is actually the optimal strategy, right? So it's a little convoluted, but it actually makes sense, right? And, I guess this is just to kind of circle it out. Well, okay, this capex boom drives the economy, drives profits, then it drives concentration, because then you see, okay, well, the people who are in the beneficiaries of this mechanism, which is just mechanical process driven by that logic I just gave you, and this new perceived technology. Well, I guess what would happen is that once people think the ROI is not going to be there, then you get a violent re-rating. And, we've talked about Korea endlessly. There's the Kospi, right? And then you have Taiwan.
That's TSMC plus the 2 Korean memory plays, right? That's driven all of that.
But it,
we talked about it last week.
I don't care if it's 10 firms or it's one firm. It's somebody's getting the business, and then people come and buy it. But you see that, right? Like in Asia, that's a lot of dispersion within Asia, right? You're talking about China. China's basically flat on the year, and they've done nothing. And India's down, but the Japan's okay. But the 2 real big beneficiaries are Taiwan and Korea, and it's because of this, right? Like, just to kind of circle it all out, and you guys probably all can just look at your charts and know which stocks were the winners and losers. But yeah, I think that's the general gist of it, that until you are confident that the government is, to the 2 levers that are really all you probably have to pay attention to from a macro standpoint, is when will the deficit will start to contract, right? So if you think about Liberation Day, what was that really about? That was worried about the deficit contracting, Doge and tariffs and all these things. And I was on that thesis, and then these guys just let us down and just, like, tariffs were there, but I think they knew that it was going to not work. And then they ended up getting rebuked in the Supreme Court. And then they were not going to go through with the Doge. And now we had the deficits actually climbing. Now we're war spending. I mean, it's just, there's been a 180 in a year, right? And then the other thing is, and I guess so, like what Cuppy said when he was on the show, the real risk to the market would be AOC or someone coming in and not caring about the S&P because they're like, hey, we got to get our house in order. And I guess if you're going to get your house, go ahead.
I think at that point you find out just how connected to the stock market the economy is, right? Because I think you get a flywheel further down when that happens.
Yeah. I think that, like, in this fiscal dominance period post-COVID, the biggest problem that most, especially guys older, have had is we use the framework of the old model, which was more of a capitalism model, right? Like private markets, and that really broke in 2008 in the GFC. And then officially it was over at COVID. And so that government deficit spending has been the big driver, but now you got the double whammy of the government deficit spending and a capex private sector boom, right? So you're getting hit on both sides, and that can then coexist with not everybody participating. So then you see certain sectors like commercial real estate and a lot of consumer not doing well, and you just associated that historically with a weak market, and that's not exactly what's going on here. So I think the reason I went through all this, and it's, again, I'm going to give a notebook LM version of the sources that kind of lays out this where profits come from more mechanically.
It's good data.
And then I'll give you a summary of all the charts of what they came out, so all our paid subscribers can see both those. But you want to think about it as mechanically as you can, because we're so prone as humans to stories. Like going back to Zeus and Poseidon, we need an explanation, and whoever is giving the sexiest, most seductive solution or answer, you're like, oh, okay, that's it. And then these narratives persist. But when you look at it like this, you're like, okay, it makes somewhat sense. Now, how we capitalize it, that's a different story of like what the valuation should be and stuff. But we all know that's mechanical too. So in reality, it seems like if you have been around enough cycles, you know how this ends. But we got to live in the present, basically.
Yeah. I mean, it's very tough. I mean, I've got a queue of trades pending resolution in the Middle East right now. And I sort of found myself staring at the ceiling in the middle of the night and say, well, listen, I need to start developing a game plan for, what if this just carries on, right? And we have a state of suspended, animation and uncertainty around whether or not, Schrodinger's strait is dead or alive. Anyway, time to wrap things up. We just hit the half-hour mark, Benny. We are live again on Thursday. Remind me who we've got.
Brent Donnelly.
Oh yeah, gosh, we're already in May. I get confused. Thursday with Brent Donnelly. We're going to talk about his new book and a bunch of other things. I certainly
probably a lot of
enjoyed all
FX.
this.
So get your FX hat on.
We'll talk about his FX trades as well. Okay, guys, thanks very much. Good luck out there. See you on Thursday. Benny and the Squirrel out.